Hi, this is first questions Janadhipathi PLC. So the I named this company for my school. So I went to President's College. So it's in Janadhipathi. So my school played a huge role in my school life, and it's still a big backup for what that I am living now. And these are my two books, Company Accounts and Cash Flow Statements. So each book have 25 questions. So those 25 questions is in a separate paper. So you can pick a questions and then answer it in a separate paper and then attach it, and then you can check the answers. And then if there are any explanation that you need, so you can watch my video. That is a one way. And if you are the beginner, so you can do these questions with my video. So there are two ways. Either you can do by your own and then check the explanations and the answers, or you can do that questions with my video, right? Okay. Uh, so if you purchase both together, so I will give you, so that's mean 2000 for both. If you purchasing one by each, so this is the prices. So I can deliver for any place in Sri Lanka. So if you're willing to buy my books, please drop me a message through WhatsApp. So yeah, I mentioned my phone number over there. Okay, let's go for the question. So first of all, my English is not 100% perfect, but I will try to explain these whole explanations 100% in mostly in English. Okay. So apologies for any bad grammar and blah blah and the speaking cases. Okay. So first one, cost of closing stock 2,400 and the NRV 1,750. So according to LKS2, when the cost and the NRV is given, you have to identify your closing stock in your SOP for the lower value always, comparing those two, cost and the NRV. And if the NRV is lower than your cost, so it is an expected expense, that the expenses that can be happen. So that expense name is stock written off. So what is cost and what is NRV? Cost is the amount that you purchased this closing stock in the past. සල්ලි දීලා ගත්ත ගන්න. But NRV is the expected minimum value that you can get in by selling that on closing date, right? So net amount. So how to find the NRV? Expected selling income minus expected selling expenses. So that's how for the adjustment number one. So inventory is debit 1,750. So this 1,750 you have to record in SOFP current assets. But always either NRV is higher or lower, that doesn't matter. You have to deduct your closing stock when you're finding the cost of sales for cost always, right? So why we are subtracting, why we are deducting when you are finding cost of sales, this closing stock? Because the cost of sales, you are finding the cost of sales, the cost that relate to your current year sales. So this closing stock you purchase, so it is including purchase also in the opening stock, but it didn't use for current year sales. So any stock that you purchase on intention of reselling, but if you are not using for your current year sales, so those stock items you have to deduct from when you are finding the cost of sales. So that's why you are deducting closing stock. That's why you are deducting stock damages, stock drawings, stock donations, or any stock that you purchase on intention of reselling, but you are not using for your current year sales, you have to minus deducting from when you're finding the cost of sales. So that's for adjustment number one. And second and third adjustments are for the proper plant and equipment. So any transaction that you are doing for the proper plant and equipment, you have to record that in note number 4. Right. So here first one, depreciation. So here the depreciation given the useful life, so which mean in the straight line method. So straight line method use depreciation is how to find cost minus disposal value. If the disposal value is given, cost minus disposal value, and then dividing by your useful life. But here in this case, disposal values are not given, so just divide the cost by the given useful life. So what's the double? So each all these adjustments have their own double entries. Depreciation double entries, depreciation debit, accumulated depreciation credit. So depreciation is an expense for you. This each depreciation, buildings depreciation, so buildings and FEC equipment depreciation, you have to record in administration expenses, and motor vehicles depreciation. Mostly motor vehicles are using for distribution and delivery purposes. So that motor vehicle depreciation you have to record in what? In distribution expenses, right? So in note number 4, this first part is showing how the cost is changing within the year. And the second part is showing how the accumulated depreciation changing within the year. So finally, the closing balances of each property, plant and equipment cost values minus closing balances of accumulated depreciation, and then you are getting what? The carrying amount. And the total of carrying amount of all these property, plant and equipment, finally you have to record in SOFP under non-current assets, right? So that's how you are recording the depreciation. And that depreciation you have to add to the opening accumulated depreciation in note number 4 like this. And third one, land should be revaluated for 12,500 on 31st March 2024. So you purchased the land in past 9,500 and now the current market value is 12,500. So the management decided to revaluate from the past value to the new value. So that's what revaluations do it. 9,500 worth land you are evaluating for 12,500. So it's a revaluation surplus for you. And this is first time revaluation. So first time revaluation surpluses, the double entry is revaluation that land debit, revaluation reserves credit. But first of all, you have to record this revaluation surplus in your income statement under other comprehensive income. Then after when you are balancing and when you are settling the old accounts, that balance of the total of other companies' income you have to transfer in changes in equity under revaluation reserve. So that's how you are doing the revaluation, right? So these are the simple adjustments for the proper plant and equipment, but nowadays the proper plant and equipment adjustments are a bit complex more than this. Okay, next slide. And yes, this is fourth adjustment, not one, fourth adjustment, director decisions. And director decisions, the changes in equity, the equity component, what happening to the equity components for the in the companies, you have to mention in changes in equity statement. So there is a separate statement for that. When we go back to the sole proprietorship, in the sole proprietorship, the equity differences, the what happening in equity, we are showing in SOXP because there is only one owner. And in partnerships, the differences of equity we are showing in two accounts, current account and capital account. And the closing balances, again, you are recording in SOFE. But in this case, companies, you are showing the differences of equity, what happening to the equity from a separate statement, changes in equity, right? As like this. So first on transfer 1,000 to general reserves from retained earnings. So reserves retained earnings goes down and other reserves general reserves increasing. So this is how you record that retained earnings minus and other reserves increasing, uh, and issuing 20,000 shares at 50 per share, so which mean reserves capitalization bonus share issue, again retained earnings. So here we are issuing shares for our existing shareholders by using reserves free. So methodically, they are getting shares without paying any amount for the business. So that's what we call bonus share issue. So the bonus share issue, when the bonus share issue happens, return earnings minus, return earnings goes down, and stated capital increase. So both these questions, the total of the equities doesn't change. Because in the first one resource goes down and one resource goes up. So the total is not changing. And the second one, bonus share issue, resource goes down and stated capital goes increase. Those both are the equity components. One equity component goes down and one equity component goes up. So the total is not changing because of the research capitalizations and transferring to the general reserves. And dividend payment proposal, you are not doing double entries for dividend payment proposals. You have to mention that in a separate note, right? But the interim dividend, so interim dividend mean you are paying dividend within the year. So those interim dividend, if you paid in cash, you have to mention under retained earnings. So that is interim dividend. But this is the dividend proposal that comes from the direct additions, right? So that you have to mention in a separate note. But if it is given the interim dividend, that interim dividend you have to minus from the retained earnings, right? Let's go for the last slide, last adjustment. Last adjustment, tax. So it's a simple adjustment that can count for the taxes, but nowadays it's a bit complex more than this. So company policy is to pay 1/4 of PBT, so profit before tax, for taxes, right? So your profit is given, so you have to to do these adjustments, you have to do first four adjustments as I mentioned over there, and then record the other transactions in the trial balance in right place, and then you have to find out the all expenses, and then all expenses you have to move to the income statement, and then you have to find out the profit. After that, you can do this adjustment, right? Profit. So the profit that you will get 5,060, 104, so 1,265. And this income tax, so there is no drama about income tax that comes from the last year. So this is purely you have to record in income statement, income tax 1,265, and then you have to check the trial balance if you paid any amount within the year for the taxes. If not, if you paid, so the difference of that you have to record in current liability, and if not, if you didn't pay any amount for the taxes at yet, so this full amount you have to record in current liabilities. So that's all for question number one, company count. So I think I tried my best to explain all this in English. So if there are anything, and come on, please do comment. So because those comments are the only satisfaction that I am getting from this, from doing these videos. So if you watch this and if you learn something from me, so please do comment. So those comments are big things for me. So just 3 to 4 words from you, but that's a big thing for me. Okay. So keep in touch. I will upload all 25 explanations. So this is first one, and 25 more to go in company accounts and cash flows as well. So keep in touch, purchase my books and share to your friends. So you are my business. Thank you.